Last week, we reported on a new Fed policy in the works that would abandon stimulus checks and instead utilize direct deposits in order to more efficiently get Americans the money they need to stave off financial insecurity. This helicopter money is a final attempt to dig the United States out of the deep economic collapse they've fallen into this year by bringing about sharp and widespread inflation. The tool, known as Recession insurance bonds, would take advantage of newer digital payment technologies that allow the government to make instant wire transfers to the tens of millions of Americans who require emergency assistance. The Fed has argued that this switch will limit the inefficiencies that have plagued the previous system, which saw citizens in need waiting weeks or even months for their stimulus payments to arrive. In the gap, countless people slipped deeper into food insecurity, poverty, and even homelessness. As a refresher, here's how these recession insurance bonds would work. The Fed would set aside a cut of the country's GDP to put into consumers' pockets, splitting the sum equally among households in the event of a recession. When the economy is doing well and activity levels are stable, the money would simply be kept on hold. Then, if red flag economic thresholds began to be crossed, say if interest rates hit the zero lower bound, or if the unemployment rate jumped by a certain percentage, the securities would be activated. This allows the Fed to wire money to countless Americans almost instantaneously, thus warding off financial ruin for households across the country. In an interview with Bloomberg, the head of the Federal Reserve Bank of New York's Markets Group, Simon Potter, an economist for the Fed's Board of Governors, Julia Coronado, said that the failure of the current policy, the CARES Act, rested primarily in its inability to target certain demographics that represented the highest financial risk. After all, a significant portion of those that received aid under the CARES Act were not in immediate need, thus taking valuable dollars away from those that could use them most. With improved data sets, the central bank officials argued, the government would be able to make highly targeted direct infusions of cash to the most vulnerable Americans, such as workers that survive mainly off of tips or employees that do not have much flexibility with sick days. While the idea of helicopter money, that's cash deposits sent straight from the Federal Reserve to Americans' individual accounts, would have been almost unthinkable even just last year, the fact that it has moved into the spotlight as a policy proposal means that it will likely be implemented sooner rather than later. As has happened time and time again throughout the pandemic, we must get used to ludicrous ideas entering the mainstream. The only thing holding back the Fed's plan now is the existence of a digital currency that could be used by the central bank. In this video, we will discuss the latest disastrous move in Fed policy, as well as what it could mean for the future of our country's financial systems. Earlier this week, Federal Reserve Governor Lael Brainard spoke not so subtly about the coming system reset. She said that the Fed was studying the opportunities and challenges presented by central bank digital currencies, but we all know what that really means. Brainard went on to discuss a new project in collaboration with the Federal Reserve Bank of Boston and the Massachusetts Institute of Technology, MIT. Together with the wider Federal Reserve, these institutions are embarking on an effort that will stretch over multiple years and ultimately hope to institute a working digital currency that could be utilized by the central bank. The most telling line of Brainard's recent speech, which was innocuously titled "An Update on Digital Currencies," was sneakily tucked away in the middle. She said, "It is important to understand how the existing provisions of the Federal Reserve Act with regard to currency issuance apply to a central bank digital currency, or CBDC, and whether a CBDC would have legal tender status depending on the design," she said. Signing a central bank digital currency legal tender status marks a dramatic overhaul of current policy. Surely there would have to be a significant stimulus to prompt such a move. So what exactly would it take for the Fed to follow through on this policy process? Another crisis, of course. And with new crises popping up nearly every day in the United States, it wouldn't take any time at all for the Fed to find a justification for this system reset. Already, other countries around the world have moved in the direction of digital currencies. Sweden is on the forefront of removing cash from their society, and China has been testing digital currencies for years. The Bank of England has already suggested a shift to digital currency. However, there is plenty of cause for concern that comes with this massive overhaul. Fears over privacy top the list. In order for the Fed to determine which sections of the population to distribute aid to first, they would need to have continual access to a database that details intimate aspects of Americans' personal lives. Furthermore, the implementation of a central bank digital currency would require some sort of public-private partnership with digital payment providers. Many of those competitors could be inspired to enter the market because it would allow them to acquire large quantities of individuals' data. Another concern is the wave of inflation unleashed by this new policy, a wave that could very easily spiral out of control, drive the value of the US dollar down to nearly nothing. Of course, we can't address inflation without discussing the latest news coming out of China. There are two ways the global financial system could go in response to this year's economic collapse. As liquidity skyrockets and global central bank balance sheets are set to top $28 trillion as soon as next year, what follows will either be mass deflation or mass inflation. This year has seen markets performing in ways that contradict historical trends recorded in previous recessions. As ZeroHedge.com pointed out in a recent article, there is a record divergence between genuine rates, which have been adjusted for inflation, and break-evens, which reflect expectations for inflation. While the real rates are sinking to all-time lows, the break-evens have surged during the worst of the health crisis. However, the question of inflation versus deflation may not even find its answer in the United States, but rather in the world's second largest economy, China. This chart shows a disturbing correlation between China's credit impulse and reflation in the US. For years, experts have warned that the possibility of a global reflationary wave rests on China's credit impulse, as this indicator is considered the most powerful driver behind economic growth. Back in 2017, ZeroHedge.com said that China was at the core of global economic recovery. Absent a huge spike in debt creation year over year, the world economy almost always rolls over. Therefore, if Beijing decides to stop expanding credit domestically and on a very large scale, the entire planet runs the risk of losing hold of a recovery. From 2017 through 2019, China's credit impulse remained in the negative. But in light of the current economic crisis, which has inflicted record slowdowns on a Chinese economy that was previously growing at an unprecedented rate, the CCP opted to again engage in economic stimulation. With new fiscal and monetary policy put in place, the country's credit impulse surged back into positive territory, even reaching its highest peak in over 3 years. And as the chart shows, there is a year-long lag between a shift in China's credit impulse and real yields in the United States. These yields have an impact on almost every vital part of the U.S. economy. The prices of stocks and precious metals like gold, nominal interest rates, and even the value of the national currency. That means that the United States' biggest competitor on the world stage and a country with which American relations have deteriorated rapidly over the course of the last several months, essentially controls the fate of major U.S. economic indicators. If this correlation persists, U.S. real rates can be expected to skyrocket in the next 6 to 9 months. In this scenario, 10-year yields could climb above 3%, a level that, without a doubt, will result in a market crash. The last time these levels were reached was in September of 2018, when stocks also crashed. For the establishment, central banks and politicians, reflation is exactly what they're aiming for anyways. After all, raising inflation will help avoid problems such as the collapse of global supply chains and the devaluation of the US dollar. But how does this impact everyday Americans or ordinary investors? According to the chief investment strategist at Bank of America, Michael Hartnett, if China's indicators, paired with persistently low consumer confidence and increasing inflation, force bond yields upward, the bull markets that have been delaying an even worse economic collapse for so long will finally give out. Adding to the Fed-driven positive feedback loop, analysts have pointed out that the unveiling of a vaccine to curb the virus pandemic could operate as the reflationary event of the century. Meanwhile, everyday Americans are suffering in countless other ways as well. A new survey from online rental platform Apartment List found that nearly 1/3 of all renters in the U.S. went into this month with outstanding housing bills. This statistic has remained at such elevated levels for 4 months in a row. Furthermore, more than 20% of those reported that they owed over $1,000. Nearly half said they were in the process of working out updated lease agreements with their landlords because of their inability to manage the piles of unpaid rent that were rapidly accumulating. Even prior to this recession, the lower 90% of the population faced enormous debts and held very little, if anything, in the way of personal savings. Since tens of millions of Americans have been forced into unemployment, people have become more reliant on the government than ever. More than a quarter of household income across the country now comes from federal aid. Of course, this was before the emergency measures expired at the end of last month. On the business side, a tsunami of bankruptcy filings has stormed numerous industries. According to new data from S&P Global Market Intelligence, a staggering 424 companies have filed for bankruptcy this year. The U.S. has not seen so much devastation in a decade. The last time this many bankruptcies occurred in such a short period of time was back in 2010. Between July 27th and August 9th alone, 31 major companies filed for bankruptcy. While the effects of the recession have stretched across sectors, businesses that cater to consumers have been by far the most deeply impacted. Of the 424 bankrupt companies, at least 100 of them were consumer-focused, including retail giants like J.Crew, JCPenney, and Neiman Marcus. Nearly 40 of the companies held more than $1 billion in liabilities, which shows that this recession will spare no one, sure to leave deep and long-lasting scars on the U.S. economy. Analysts don't expect the wave of bankruptcy filings to stop anytime soon, and warn that it likely won't even slow down its breakneck pace. Even if economic indicators were to move towards the positive tomorrow, the damage to businesses would last well into next year. Of course, that is only a hypothetical. With the state of the health crisis in the U.S., economic woes will only worsen. California just became the first state to reach more than 600,000 cases. Florida and Texas are not far behind. Canada has announced that it will continue to block Americans from entering the U.S., with border closures extending through September 21st. All in all, the U.S. is continuing on its dangerous downward slide into economic ruin, and as we discussed, much of the country's fate now rests on factors outside of domestic control, such as China's credit impulse. It's a dark world we live in, and the outlook is looking bleaker every week.